I'm here with Casey Allen, the founder of the Enterprise Rising Conference. Casey, who is Enterprise Rising for?
Enterprise Rising's tagline is 100% enterprise SaaS, 100% Midwest, and 100% startups. So if any of those click with you, listener, and sounds intriguing, or better yet, 2 or 3 of them click with you, then this is going to be for you. And if you're an investor, over 50% of the room are startups that are live with revenue. If you're a founder, all of the speakers are successful founders or active investors. Nobody hand-wavy, nobody wasting your time, and all the talks are hyper actionable.
How is Enterprise Rising different this year?
If you've ever attended an online event, you know networking sucks. Slack and Discord really just don't cut it. So we have custom built for Enterprise Rising 2020, an online platform that's like Startup Masterclass meets The Sims, where every attendee has an avatar, you're in a building, you're sitting in chairs, you're sitting in couches, you're having real video chats with the people next to you. So what we've done is we've recreated an actual virtual environment where networking happens just like it does in real life.
Casey, when is Enterprise Rising and how can people get involved?
Enterprise Rising is the end of October, the 20th and 21st. It's 2 full days. It's all online, so you can dip in and out for as much or as little as you want. Go to enterpriserising.co. That's enterpriserising.co. And you can use discount code UPSIDE to score 20% off as many tickets as you want. So discount code UPSIDE at enterpriserising.co. All the details are there. The entire conference is online. It's going to be a great time.
My own thing is I don't usually write more than a couple of pages, and the deck is always available. But I'm also like, my one superpower, I'm sure any LP would tell you, is responsiveness.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Accredited Investor himself, Eric Hornung.
We did it, Jay. It was all me.
We did it!
Legitimately, nothing has changed in my life. The SEC just changed their rules. Well, technically, as I'm recording this, I am not an accredited investor since it is 58 days on the countdown from this recording until the SEC's rule actually goes public. But yeah, man, I have the potential in 58 days to be accredited and actually be allowed to invest in private companies.
Is there like a certificate of authenticity you have to get that you put on your wall? Like, do you have to apply for this? What does this mean?
Maybe I will just get it. Maybe I'll get some commissioned art that just says Eric is an accredited investor, and I'll hang it on my wall. Or I'll hang it on a digital wall. Ooh, that's a little foreshadow for an episode to come.
You need to put on the wall directly behind you so I see it every time we record like this.
Yeah. But no, there's nothing that you need to have, depending on what regulation D raise you raise under. Your lawyers and accountants may have to sign like a letter to say, yes, you are accredited. But usually it's just a personal attestation that you're accredited.
Give the people some insight here. They're probably wondering what's going on. Is Eric now worth $2 million? Like, what's happening?
No, Eric is not worth close to $2 million. But the SEC for the longest time has said that an accredited investor is an investor who makes $200,000 a year and projects to do so into the future, or is worth $1 million without the value of their home. I am neither of those things. And in order to invest in private companies, you pretty much need to be an accredited investor. There's some loopholes and ways around it, but for the most part, you need to be an accredited investor. In order to run a syndicate, you need to be an accredited investor. In order to run a rolling fund, you need to be an accredited investor. So the SEC finally came to its senses. Is that a good way to say that?
You're putting a lot of judgment on that phrase, but yes.
Well, the SEC has been judging itself for like 10 years as they've been talking about this, where they believe that having knowledge about a space actually makes you a knowledgeable investor, which is a crazy concept. And they started down a path of allowing people who work for private funds and people who have certain credentials, the first 3 being FINRA credentials, to actually be accredited investors, which is pretty exciting.
Well, it sounds like the SEC is helping you live the one life that you have to live the best way that you can, Eric.
Yeah, just like our friends at Ethos Wealth Management, who are now accredited investors if they weren't before. And if you want to learn more about Ethos Wealth Management and living the best life you can go to upside.fm/ethos.
You mentioned running a syndicate as something that an accredited investor can do. And Eric, we're going to learn a little bit more about that here today. Today, we're talking with Ashley Flucas, an angel investor and the lead of Flucas Ventures. She is the general counsel and a partner at a real estate finance fund, but has also been investing through her own syndicate fund, Flucas Ventures, for the last 2 years, Eric.
One thing that I'm really excited about with Ashley is she has so many deals on her site, but it seems like she's relatively new to the syndicate space from a lead investor perspective. So I think we've had Peter Livingston on, and he has spoken to what a mature-ish syndicate looks like. This is going to be more of like a startup syndicate almost.
She says she shares primarily pre-seed to Series A stage deals, but anticipates occasionally sharing some late-stage deals. She's based in West Palm Beach, Florida. She's been investing since 2018. And like you said, there are a ton of companies listed on her website, flucasvc.com, that she is invested in herself through syndicates and now is leading some deals on as a syndicate lead herself.
This is a path that we've been trending down here, Jay, where we've been talking with syndicate leads. I'm hoping to bring on a rolling fund into the future to talk about that different model. We've really been looking at a lot of investment models. And dear listener, if you know anyone who is employing a non-traditional investment model, or you just are interested in this topic in general, you can tweet at us at UpsideFM or send us something a little longer at hello@upside.fm. And we will get to that interview right after this. Let's bring in Rob McDonald, a partner at Taft, Steneus & Hollister, to teach us about private placements and fundraising. Taft is a law firm known for assisting entrepreneurs across the heartland. As a reminder, the following remarks by Taft attorneys are for informational purposes only and are not legal advice. This information is not intended to create, and receipt of it does not constitute, an attorney-client relationship. No person or organization should act upon this information without first seeking professional counsel.
You know, Rob, we talk to a lot of founders and we often hear this idea of smart money. How do I identify investors that would be a good fit for my startup?
I always encourage startups to do as much homework as possible identifying potential investors. Now, more than ever, there are plenty of resources available to help founders with this, namely Crunchbase, AngelList, and PitchBook. Using these sources and Google, triangulate investors that invest in the dollar amounts the startup is targeting, invest in the vertical of the startup, and invest in the geography of the startup. Shockingly, if founders can triangulate these three things, usually we aren't going to be talking about a huge list of investors. From there, develop and use their network to get introductions so that you can avoid fruitless cold emails to investors.
Awesome. And if people want to learn more about Taft or yourself, where should they go?
The best place to go is www.taftlaw.com or my Twitter @RWM.
I'm a lawyer by background, and that kind of was not really intentional. It was just I was in college and I thought, and I was a political science major, so I kind of had some exposure to it, and I thought I'll have a reasonable aptitude for it, and I'll be in the room with people who are doing a lot of different interesting things in terms of corporates, VCs, funds, banks, and maybe I'll kind of, through osmosis, figure out what my passion is. So I started practicing just in 2011, and I ended up going into capital markets law, which has been kind of perfect for transitioning into what I'm doing now. And I started off my career working in London, and that's what was nice about practicing capital markets, is because you can be anywhere in the world because all corporates need advice on U.S. debt and equity markets. So did that for a couple of years. Then in 2013, came to Florida, where in short order, I ended up going in-house at a real estate finance fund. I'm actually still there today and balance my, angel investing and syndicate activity with that fund. I'm the general counsel and a partner as well. And in a nutshell, that fund, what's niche about it is we pool all our capital from high net worth immigrant investors who are investing pursuant to something called the EB-5 program in the US. And kind of similar to my syndicate model, we spin up SPVs relative to specific projects. Folks invest in the SPV relative to that specific project. And then from there, we're more of we're a traditional shop in terms of making senior mezzanine loans or preferred equity investment. And the scale of that is, probably like 10 million on the low end. And the biggest singular loan we've done was almost $500 million for a project called 702 Times Square. And we've got about 3 billion in terms of total assets under management. So that's kind of the day job. A couple of years ago, literally, I just started thinking about this venture capital again, after some exposure to real estate and private equity. And I thought, let me play around with it and just started angel investing. At that point, it kind of started off as, AngelList, other platforms, a few folks that I knew who were doing it. But, I'm in Florida. I'm not in, Silicon Valley. And, and I'm sure we'll talk about that. Not the most robust startup ecosystem, but start utilizing some of these, online platforms, realized that I was doing it fairly aggressively and kind of had a passion for it. And I think with my background, have a ability to digest a lot of information quickly, because as a lawyer, you diligence, you write memos, all of that good stuff. Then I just started saying, okay, instead of just seeing what comes to be, why don't I start hunting a bit more and start getting more aggressive, finding deals and switching to more direct investing as opposed to syndicate investing. And then when this year rolled around with kind of the confluence of a bunch of different things happening in the global environment, I thought, one, I don't often see women or African Americans in this space as investors, as leads, and particularly not on this side of the country. And with all going on from a race relations standpoint and VCs wanting to do more in terms of equity there, I thought I should do something here and try to be more visible. One, just be visible in the space as a woman of color. Number two, I like to think that I don't have those, as a woman of color, I don't have those filtering biases. So when I meet a great company and it has an underrepresented founder, I'm looking at it the same way as I'm looking at any other company. And it's not that my investments are solely in those types of companies, but it's just so worked out that in terms of the investments that I have led, there's usually some team that's fairly diverse or a diverse founder or that kind of thing. And that's been really positive. And then I started doing the syndicate model really within just like the last 6 weeks, but I'm like 5 deals in and it's been going really well so far. So that's my spiel.
If I can clarify one thing, it sounds like when you were starting to do some of this angel investing, were you investing into other people's syndicates on AngelList?
Yeah, so I was, and even though I've not been doing it that long, I've had quite a few folks reach out to me like, I've always been thinking about doing the syndicate. Like, how'd you get started? What were you thinking? And I think the way I started it, not that you have to wait as long as I did to be a lead, but it was a good way to go about things because I started off purely like angel invest. I think maybe did like one thing on like seed invest, but it was kind of just like learning, like how does a lead diligence a deal? What information do they synthesize? How do they synthesize? Just kind of, going through pitch decks, and you go through so many of them, like even if it's not a company you invest in, usually you take away something in terms of how something was presented or just learning more about different, business models and getting, smarter in that way. Particularly, me, I'm a lawyer, but I don't have a tech background, but that doesn't mean that you shouldn't be investing in spaces just because you're not, a marketplace expert or, a technologist. You can still get through as long as you, challenge yourself to kind of build that acumen. So for me, following other folks' syndicates, investing via syndicates was like a huge education. And it was also beneficial from a networking standpoint because when I was ready, to kind of launch my own thing or go more direct, then I could speak from a position of knowledge because I had, been involved, albeit indirectly, with some pretty cool companies. And then I, felt comfortable approaching those leads and saying, hey, would you mind backing me? Can I ask you questions? If I roll out a deal, would you mind, taking a look, everything else. So that gave me a really great base to kind of accelerate things to the way that I have recently.
You have a ton of active deals on your portfolio page. I think it's like 115. So when you're beginning to invest into syndicates, before you said, I want to start hunting and start leading, were there any moments or events or companies that made you look and say like, oh, this is working and this is like a good return on my time and a good return on my capital?
That's a fair question. For me, obviously it's fairly early. So, it's not at the point like there's been, some markup or exit where I'm gonna retire. But I think like I said, it kind of all did come together kind of as the world was shutting down, because obviously, while some portfolio companies are not going to do well potentially post-COVID, there are a lot of them that this is all an accelerant. So as I kind of saw a few different companies that I had a thesis about, but that, might have been a couple of years early, and then seeing the velocity at which that kind of picked up around, even as early as March, April, I'm like, okay, like I can kind of see like what happens like when you get out of that first gear and you just keep growing. And then in some other companies, like for example, investing in Bolt and just seeing like, year on year how much the growth in terms of the volume of transaction processing and being able to see that, and you're like, okay, this is like, you see kind of the snowball effect of things. And then, as I mentioned, like the things that are subject to COVID accelerant, like one portfolio company, for example, like touring, which is focusing on remote work. I always thought that made sense, but now they're kind of looking like geniuses with the world the way it is. So yeah, that's kind of been the experience.
How many of those 115 deals have you run through the syndicate versus were direct angel investments or indirect angel investments?
So as I said, the lion's share when I initially just started was me going through other folks' syndicates, whether that's AngelList or folks that I know off platform, and we're pulling things together, or angel groups or whatever else. But I would say from a ratio standpoint, probably something like a quarter are in the direct or syndicate model. And from a distribution standpoint, now it's much more loaded towards direct and syndication. I will, of course, invest in a syndicate if it's a great deal. Why wouldn't I? But I am more focused on the direct model and things I can syndicate. But like I said, the syndicate itself just really launched like within the last 6 weeks, and I'm 5 deals in with 3 closed, 1 closing out, and one about to launch.
How do you think about investing in a company, looking at an investment opportunity when you're making an angel investment on your behalf versus on a syndicate's behalf? Is there any difference in the investment due diligence or memo or anything that you do differently between the two?
There are a few different dimensions along where it's different. And one thing which I try to carry over and be really mindful of, particularly, since I'm, experience with working in a fund, granted, a real estate fund, is not get addicted to the lure of other people's money. You still have to, and based on some deals I see, I don't think everyone necessarily follows that standard, but I really try to earnestly ask myself when I evaluate a deal, if I were the one writing a check for maybe the size of the total allocation, would I still write this check personally? And I have to answer myself that every time, or there is arguably not a great deal if I wouldn't take that, if provided I had the ability to write that size check, whatever it is. So that's kind of number one, and I try to always go through that mental exercise. The second aspect of it, and I always say this when I'm talking to founders, particularly, in recent weeks, is I always still first look at the deal as a personal investment, and I co-invest, in the vehicle. Granted, maybe the check size isn't as big as when it's a purely personal investment, but I always try to first filter it through that personal investment standpoint. And I say, sometimes things make sense for me personally that I just don't think resonate from a syndicate level. And that could be because you're kind of really early on. So maybe you don't have the kind of strong signalers that might resonate with LPs in terms of institutional VC capital, or it's a really great product. A lot of things are aligning, but it's just a little early, maybe from an ARR standpoint, those kind of things. But, it might be within my risk profile. And so maybe I'm willing to write a decent sized personal check. And if that's the case, I've had some good conversations where I could say, look, it's a little early for the syndicate because this is kind of like, they like fastballs down the middle, solid traction, great VCs, all of that stuff. My risk profile is a little higher, and I've got the ability to play around a bit here. So why don't you let me come in personally, whether it's this round or the next, and some of those other signals fill in, then I'll bring it to the syndicate. And that's been a pretty good compromise so far.
How do you know what your LPs or backers like? Like, what's the onboarding process to become an LP of Flucas Ventures?
I'll be honest, I'm still evolving in my learning on that, because it's kind of like you're a mad scientist tinkering. You might get something and you think this is can't miss. This is the thing. It has all the signals, and you'll get the deal done. You'll get it closed, but you're like, man, I was thinking I was going to get, quadruple that. Same. And then by the same token, you put out something, you're like, I'm putting it out. I believe it's a good deal. I'm expecting, maybe I'll get $100,000, $150,000, and then it's blown past 500,000, and you got to scale people back because you only have so much allocation. So I'm still tinkering, kind of learning that. In terms of the LPs, at this point, in rather short order, and probably some of that is the nature of AngelList, I'm at over 400 LPs, so it's just not possible to individually manage every relationship. But what I do try to do is, whether it's reaching out or being responsive when LPs reach out, if I've got a free moment, I'm just always chatting with them and doing my best, particularly for folks who are active, in this world, to, let's just chat for 15, 30 minutes, or someone invests in a deal, or even maybe someone rejects a deal. I'll just send them a note saying, okay, this wasn't in your wheelhouse, kind of what works for you, just so I can keep an eye out in terms of flagging it for you the next time I see something that's within that space. Or even if, I get a deal and I don't think it's right for the syndicate, but this is really your lane, I was like, I'll send it to you. Maybe you can direct invest. So it's a lot of that, just the tinkering. And then, these are smart people asking great questions. So even just the questions they ask, you can kind of reverse engineer and figure out, okay, this is what matters. The next time I come out with a deal or a memo for this sector, I should really make sure from a diligence standpoint I'm covering this, or at least from a memo standpoint, flag this, because these are the details that resonate with them.
Something that you mentioned a second ago that got me thinking, when you're considering sending it to the syndicate or investing yourself, because maybe the risk profile is a little bit higher and that's a better match for yourself, how do you think about your hit rate of, I sent this deal to syndication and it got filled or it didn't get filled? Are there any best practices or even guidance from AngelList to say, you want to have this high of a conversion rate of going to the syndicate with a deal and actually closing it?
So, knock on wood, I think it's an eventuality with the syndicate model, but so far I've not had a deal that hasn't filled, and I've just been very fortunate from, kind of the OGs on the platform who I've talked to. You're not going to have 100% success rate. So that's just going to be an eventuality. So I kind of learn more from talking to other people, how do you deal with that? And that's, like you said, that's the nature of the model. When I put a deal out, I have no control over the velocity of it and the ultimate amount. So you need to really be sure there. And one thing that I've tried to do to backstop against that, and I actually did it this morning before the call, is if I see a deal and I'm like, I think this is a great deal potentially, but I'm just not sure if I'm going to get there from an allocation or from a subscription standpoint, or if I should be, even though I think it's a good deal, or if I should be the voice for this particular deal. There might be another lead on the platform who is, a prop tech or fintech CEO or product lead. And if that person puts this deal out, I think it's almost a no-brainer that it's going to subscribe. But, for me, I'm learning what people think that I'm an expert in, despite what I might say I'm an expert in. So I think people are starting to perceive me as being strong in LATAM, even though I didn't set out to do that. It's just I put out a couple of deals just because I like them, and they've just gotten a great response. So like I said, I had an example this morning. I saw a prop tech deal, and I was like, wow, I really like that. I obviously have a real estate background, but I just don't know on a couple of items how I'm going to position this. And so I have an LP who's also a syndicate lead, and he's the CEO at a prop tech startup. So I was like, you know what? I'm going to shoot it to him, get a second set of eyes, see what he thinks. He was like, no, this is actually a really good deal. And obviously shooting it to him knowing he's going to be a strategic potential fit for the company. And kind of my attitude, and I hope I always keep this, is that, yes, I'm not doing this for the good of my heart, but, so early on starting out, like relationships matter a little more than, getting every possible point that I can. I'm very open-minded about, quote, co-syndication as well. And if I see a deal and I just know it's really suited for someone else who's also very strategic, and I know that because I back a lot of syndicates and I've backed a lot of deals, so I kind of have a feel for some of the stronger leads where their thesis is. I'm like, fine, like I'll do the deal together, share the carry, all of that, because it's going to get it done. And, more importantly, it's going to help me in my education, my process, and I'm going to help that founder as well, because if they can get folks who are that caliber to evangelize about what they're doing, obviously that only helps me, because that, at least somewhat, it slightly increases the likelihood that they'll have some long-term success.
I love that concept of, I've never thought about this in a syndicate, where in like the startup world, there's the classic founder market fit or founder product market fit. And in syndicates, there's almost like lead deal fit. That's super interesting. You mentioned share carry with co-syndication. Can you talk a little bit more about how tactically co-syndication works? Like, is it a informal agreement? Is it something structural? Is it just naturally, is there an industry standard where it's a split 50-50, or you get 2 points, or how's that work?
I can't say that I know what the standard is. I mean, I think it's just a conversation. Like, you have to be comfortable having, up front, and there could be a variety of factors, right? So if you brought the deal, if you're carrying the laboring or all of that, if you're doing the memo and all of that, and someone, they're a great fit, but, maybe they're not pulling as much on it, then maybe you work out some custom, some custom thing. Maybe you're taking 2/3, they're taking 1/3. Generally speaking, for myself, and I think it's more of the standard, if I'm reaching out to someone for co-syndication, it's because I expect that they're going to be able to provide a lot, not just in terms of bringing their LPs, but because this is someone who I want the company to be, connected with, and, through whatever the life cycle of the company is, can work with me and be a sounding board, or if we have issues that crop up with the company or fundraising, that can really be a, kind of a special partner with respect to whatever that company is. So for me, generally speaking, my default is, we'll just go even on it unless there's some other circumstance that dictates that we should shift one way or the other.
Can you explain to me how you think about deal memos? We talk about deal memos on the show, but we haven't really dug into one. So when you're writing a deal memo for your syndicate, I'd love to know, one, how much time that actually takes, and two, what you include in those deal memos.
Yeah. So again, this is another one of those things where I felt like I had some great advantages going into it, because by the time I started my own syndicate, I'm sure that I've probably read 1,000 deal memos at the point, or at the end between memos and decks. So I had my own strong personal view about what are the strongest memos that I read, or in certain deals, particularly like some of the stuff that's not in my wheelhouse, like, I did a deal for like a time series database. I'd never heard of that in my life before that deal, and still did it. But like the memo was just so strong in terms of like, okay, explain it to me like I'm 5. And I'm like, okay, like, I don't know really much of the technical stuff, but wow, I really get why this is a problem for companies and why you need this and the scale you need to do it at. And then I also really understand the solution you're putting forth and the team based on what they've done in similar companies, why they're the guys to do it. And it got me past it. And I could probably point to, several examples like that. And I just kind of always mentally kind of collect those examples. So candidly, when I went to do my first, I went back because you can still look at deals that you actually invested in, which is even great as a filter. And some of my favorite deals, and I just I read memos for a while and I kind of pulled out what are the things that got me there. And then I kind of put together, before I ever even had a deal, kind of put together a template of, I always want to hit, these various things. I mean, obviously in today's world, for example, I'm always going to talk about COVID impact, good, bad, or how they're mitigating. I'm always going to talk about the advisors and the co-investors. I'm always going to talk about what's signaling product market fit and a couple of other things like that. I'm always going to make sure I kind of do the too long, don't read at the beginning to give people highlights because everybody's busy professionals. And sometimes you just see the highlights and you're like, or flip a few pages of the deck and you're like, and see who the co-investors are. I know I've been guilty of this a couple of times and say, I got everything I need here, or at least to take a flyer on it. So I always have my highlights. And I'll geek a bit with, go down and explain a bit more for the folks who really want to dive in. But my own thing is I don't usually write more than a couple of pages, and the deck is always available. But I'm also my one superpower, I'm sure any LP would tell you, is responsiveness. And I'm an inbox zero kind of person. And that's probably from days being a firm lawyer, carrying a BlackBerry back in the day. So if people have questions, I get back in rapid order. So, and that creates a nice dialogue and generally leads to, if someone usually engages me in a question, I'm finding there's a 95% conversion rate. They then go on to invest. So I don't mind the memo not being War and Peace because I like having that engagement with investors. But back to your first question, how long does it actually take? Because now I've done a few of these. I kind of have my template. I mean, to be honest, once I've had the conversation with a founder, and I always take notes during those calls. So I look at my notes, I look at the deck, maybe some press or collateral, and I kind of just go through source by source and fill in the memo, or maybe even redline an old kind of memo and then add things that are unique. For me, probably 90 minutes, to be honest. And I don't know if that's slow or fast. That's just kind of me. And I've even heard of some leads who have even interns or MBAs who are writing that. And I mean, that's interesting maybe in the future, but for now, I enjoy just kind of getting my hands dirty. And, I'm a lawyer, so I'm kind of used to, cranking out stuff. So it's okay so far.
I would love to hear somebody listen to the show. We've done 2 shows now about syndicate investing, you and Peter Livingston. And there are some listeners of the show who are certainly in a position to join a syndicate, maybe even start a syndicate. But let's start from the join side. If I'm going to enter basically your shoes a few years ago, beginning to invest into syndicates, how would you advise them on getting started, what to look out for, how much to allocate, all those types of questions?
No, those are excellent questions, because obviously I learned a lot by doing, and if there are certain things probably if I had known, it might have accelerated things, but everything in due course. One, I am a big fan of AngelList. Some folks are, some folks aren't. But I think if you're outside of Silicon Valley, I just don't know, or New York, I just don't know how you could break into this world without it, just because of the density of folks that they have on there, and just the way it's set up. It just makes sense, particularly if you're outside of Silicon Valley and you can't really pound pavement, because I'm in South Florida, and I frankly can't No, the only thing about AngelList is if you get on, it's not necessarily like there's like a way to kind of you join and apply to syndicates, and you can, click on syndicates and read a little bit more about their investment, but you don't really necessarily know, like, is this a good syndicate that I should follow, or there's hundreds of them and who's active and who's in my wheelhouse. So that tends to be a little more manual. I think one way, in my own experience, some people have shortcut is so many people are on AngelList. So maybe you have a friend that's on it, or someone you feel comfortable reaching out to that you can see clearly from their profile that they're active on AngelList, and just kind of make the ask, which people ask me all the time, and I'm happy to do it, which is, I can't opine on every syndicate, but from my own personal standpoint, here's a list of 10 that I think great deal, high volume, good people, responsive, will go back and forth with you. Get started on these folks until you get comfortable, and then just kind of let it build organically. And then the other pieces of advice I would give for, folks getting started is just be judicious about how often and how frequent you're investing, because it's almost like going to the casino in some ways at first. Like, you do it and you hit the button the first time and you're like, I just invested in a startup. I have equity. What if it goes on to be Uber and stuff? And it's probably not, to be honest. That's just the law of averages there. But it's hard not to, if you're passionate about this stuff, like, not get addicted, not want to invest in everything you see, or come out the gate with really strong checks. And I'll tell that because I've had some folks that I brought from offline to AngelList, and they're like, should I put X in the deal? And even though it's counter to my interest, I'm like, absolutely no, you should not, because I'm going to be offering a lot of these, and I think you shouldn't pay and spray, but at the same time, you should personally kind of index, be exposed to different sectors, things with different timelines, maybe some different stages, and kind of treat yourself and your investing as you would, your stock portfolio. So yeah, I was like, don't be so overeager that your first deal that you see that you like, you write a check for, depends on what your means are, but, $100,000, and then you've got, 10 grand left for the rest of the year in terms of what you want to allocate to startups. So, take it easy. And for me, my own philosophy is, so far, I always keep my deal minimum really low, which is the minimum they require, which is 1,000, because I want to democratize access. I want folks who say, maybe this deal is early, so maybe I don't want to write 10, 20, 30,000, but I'll take a flyer. And, from what I can see so far, all the LPs are quality and value add, and I want them in my deal and part of the network. So, and those things, as you scale your network, those smaller checks add up and make as much of a difference as the bigger ones. And then I think the other thing I would say to people is social proof it matters. I mean, most of the returns go to the top VC funds. So if you're, cousin's friend sends you a deal, you should look at it very carefully. And probably those aren't the deals that are appropriate for this world. But at the same time, there are a lot of brilliant funds that have invested in however many unicorns, but you don't always get to hear about all of the spectacular failures as well. So when you see a deal and maybe you have a certain expertise, whether it's, real estate or whatever, and these margins or unit economics or whatever else just don't make sense, or you're kind of out of the Silicon Valley echo chamber and this doesn't make sense for people in the real world. And there's a lot of deals that are hot deals in the Valley that are putting forth things that just don't resonate with how people live on the real world or mainstream or Main Street or what's even in the realm of affordability. If you feel that, do not override your gut and don't just invest in it because a really great VC lobbed a check at it.
Are there any third-party syndicate evaluation groups or fund due diligence groups?
So I'm a member of a couple of angel groups like Angels and Life Science Angels. So those, I guess in the sense of those angel groups, and I've had scenarios particularly things in biotech and life sciences. I'm like, look, I have exposure to those deals. I happen to like those deals because there's a lot of IPO and M&A activity. And if it's not developing a therapeutic end-to-end and has some kind of FDA fast track angle, for example, you might actually be able to see an exit much sooner than you would in tech. So I like them, but they could tell me anything in terms of like the technology and the science, and I'm not going to know. So for deals like that, I will go to those angel groups like Life Science Angels and say, great deal. I'm not going to syndicate it or invest in it yet because they could be saying anything, but you guys are all physicians, doctors, professors, work for pharmaceutical companies. You'll be able to do that part. I can ask the questions that I like to ask, and then we could figure out if this makes sense. And I know a lot of, some of the angel groups, they all operate different ways. Some kind of like the heads at those angel groups just kind of push out deals, and maybe there's some Q&A, it's take it or leave it. And then there are some where there's actually like a real collective, collaborative due diligence. So that's a great way. And I should have mentioned that as well. Besides AngelList is, do your research, find local or remote angel groups, then look at their portfolios and say, hey, that's something that I would have invested in, and just reach out and see about joining. They all work differently. Some charge a carry, but there's no membership fee. Some charge a membership fee, but there's no carry. So, you're saving compared to if you were investing in syndicates. But then you've got a network of people who are looking at the same deals, who like to angel invest. And those are people you can learn from or get mentorship from or bounce things off of.
How about third-party groups? Like, I'm thinking about like Cambridge. They look at all of the top venture capital funds and go do an evaluation of them, or fund evaluation group. They look at all the hedge funds so that LPs have some third party to turn to. Is there something like that in the syndicate world where someone goes around and evaluates each syndicate lead and issues a report or something to potential backers?
That's a really interesting question, not to my knowledge, but then now you just gave someone their next business because that is probably inevitable. Because, for folks trying to figure out who to back as a syndicate, all you really have is like kind of this like hodgepodge of different sources. So you can look at their LinkedIn. If they have a website, you can check it out, but not everybody's going to have a website, and that's all, that's coming directly from them. You can Google, but not everybody's going to have a rich internet history. Within the context of AngelList itself, you can see their AngelList investments. And, once they've closed, you can see the deals that they've led and kind of get a feel. But that's kind of as best as I think you can do, or at least I'm not privy to somewhere the source where you can go and, there's like a league table of the top syndicate leads, but I'm sure this sector would welcome that, just kind of like they do. I guess it's not really the same. It's not the same because I don't really know what criteria they use. I think it's like Forbes or Fortune that does like the Midas list, which is like, here are the top, 100 angel investors, but it's kind of opaque about how they're deciding that, other than presumably they had a good exit. So unfortunately, that doesn't exist, but you can kind of use some of these other things as a proxy if you look at their deals they've been in, like I said, and their background and go from there. And that's why I think the social proof becomes important as a syndicate lead, because maybe they don't know if you're an expert in fintech, but maybe PayPal Ventures is investing. So then the LPs are like, I'm pretty sure they really kicked the tires on this. I feel really good about the diligence because of who else is on the deal. And because, syndicates tend to go fast. A lot of times, you're syndicating and you're last money in, you're wrapping things up. Maybe you've only got a week, maybe even less to wrap up commitments. So there can't be this, long drawn out process. So that's when the investors are going to look to those other signals, like particularly, like I said, the social proof, and say, okay, it's marketplace. I don't know, Ashley, if you know anything about marketplace. I haven't done any deals where they're in it as a lead, but if they saw FJ Labs there or something, they're like, yeah, they know what they're doing on marketplaces. So this is probably pretty solid in terms of the diligence that's been done.
You said about 6 weeks ago you started your AngelList syndicate. How are you thinking about your own goals and what you hope for that through the end of the year or through the next 2 years? What type of goal structure do you have for your own syndicate?
Kind of my approach, I think I'm continuing the same approach, which has made me happy and be personally fulfilled in that I'm just kind of letting it be very organic. Like it started out as syndicates, then it went to direct, then it went to leading syndicates. And I just kind of keep an open mind, always look out for opportunity, but I'm not putting any real specific goalposts in terms of I would like to have raised X amount of capital per year. I need to fund X amount of deals per month or per year, or by 2022, I need to raise a fund. I just want it to be more organic because, again, I want to keep my ears and eyes open because if I do that, then whatever that next step is, it's going to come, it's all going to kind of clear up and come into place what the next step should be. I will say, because obviously we're working in a real estate fund in a shop that's more institutional, I'm not sure if that's where I want to go, but I'm open to it if that's where it all leads. But right now, I'm having a ton of fun and learning about it a lot. I was one of those people who thought I'll just be chasing kind of checks because I'll never really be passionate about anything. Like it's all kind of widgets to me. But I found that that's because I like this. I'm not an operator. I don't want to be an operator, but I do love investing in startups, and it aligns very much with my personality. So I think I'm just going to keep doing this for a while and just kind of see where it leads me.
You've talked a little bit about, especially outside of the Valley, and you mentioned AngelList is a great place where when you can't pound the pavement. We heard from Peter on a previous episode that his LPs weren't exactly thrilled with him being from Florida, so much so that he said that he moved to the Bay Area to launch his syndicate. Do you feel any of that same or similar pushback from your backers and LPs?
That's really interesting. So far, no, it hasn't come up, but I also could be, the timing of when I got started. And I had a couple of things working for me. One, at least for the moment, renewed interest in hearing from voices outside of Silicon Valley in terms of geography, race, gender, all of that. So that's, I think, been in part an accelerant for me and people who want to get behind it. The other aspect is we are now in a Zoom world, and we can't go meet, at a members only club or grab lunch or a coffee. We've got to fire up our laptops and make it work globally. I can't go talk to startups in Silicon Valley even if I wanted to, and business still has to get done, and I'm able to manage those conversations remotely. So I think there's probably, it's been a bit fortuitous that I'm starting when I start, because it's now accepted that you don't need to be on the ground. So I'm like, great. And like I said, that was part of the impetus for me getting started as well. I'm like, okay, like I'm not geographically disadvantaged anymore because I can talk to, someone in India or Silicon Valley or Austin, and it's fine. And we accept this is how we communicate. So I have not had those issues. I will not be moving to Silicon Valley, even if my LPs say they'd like me to be there, and I'll move on to something else or stick to real estate, I guess, because I love being in Florida.
What do you think has been more successful in creating jobs in the state of Florida, the EB-5 program or startups?
Obviously, you're pulling at two different heartstrings there, but my honest answer is EB-5. One, because I have internal data just about the number of jobs that we have created in terms of construction jobs on some of the projects in our real estate portfolio, and it's tangible. Real estate is enormous business in Florida, and a lot of folks take advantage of the EB-5 financing, and you can see, like I said, particularly on the construction side, and then some of the support stuff, engineers, lawyers, architects, sales folks as well. There's a lot of well-documented evidence of that, and there's a a condo or a medical facility that goes up every 2 seconds in Florida. The startup ecosystem, I mean, I've been having some interesting conversations because there's a lot of money in Florida. There's a lot of family offices. There are a lot of real estate magnates, but there's not, it's still evolving in terms of who are the go-to funds here. And you're seeing like some snowbirds come down. And there's no reason, particularly being a gateway to Latin America, why, this corridor shouldn't absolutely be booming, at least maybe comparable to how, Texas is rising. It just takes someone doing that and making that effort. And so while I was still, obviously I'm open to startups everywhere, but that's something that's been in the back of my mind as time permits in terms of one of those next kind of like doors to try to open up is being more conscious about what is in my own backyard, whether that's, startups based out of South Florida or just deepening in terms of ties to LATAM, because it's definitely under harvested here.
Awesome. Ashley, it's been great chatting with you here. If people want to learn more about you or your syndicate, where should they go after the show?
Obviously, if they're on AngelList, they just have to search my name, which is Ashley Flucas, or the name of my syndicate, which is Flucas Ventures. I do have a website, which is where you saw the portfolio, which is just flucasvc.com. Or they can look me up on LinkedIn, and there's information there about the syndicate and getting involved. And generally, I'm kind of not one of those people. I don't treat LinkedIn like it's like, a social network and I'm only connecting with my friends. People reach out to me on LinkedIn all the time out of the blue, and some of it can be a little spammy, but sometimes it's really awesome people. So ping me there, and there's a very good chance that I'll want to strike up a conversation about any and everything venture capital.
All right, Jay, we just spoke with Ashley from Flucas Ventures. Here's my question for you. Do you think 6 weeks into launching a syndicate, you could have over 400 accredited LPs?
No. Me personally?
Yeah, you personally. Me either.
Really, really doubt it. I mean, that's, even if I'm thinking like, okay, how would I make that happen? We've built a pretty good network here, but that's still like a lot of hand-to-hand combat, just like personal, high-level outreach. So super, super impressive, which isn't surprising given, what we said from the outset. Ashley has a ton of deals that she's been involved in some form or another, and not your typical investing background. It seems like she just, built an independent interest around this and saw how she could start investing into syndicate deals herself, and has been really running at it for the past couple of years.
Her answer to it usually takes her about 90 minutes to write an investment memo blows my mind. I mean, that's so impressive to be able to look at a company, see the documents, think through everything. I mean, we do it on a 60-minute call here, but we're not diving in and actually allocating anybody's capital, our own or others. So to be able to be confident in 90 minutes and then have the understanding from actually being an investor to see what investors want to see, to the point that she said she hasn't had a deal that hasn't been filled. Crazy.
I have to think her legal background helps too, because I mean, if I was investing into a syndicate, somebody with a legal background who could look at the deal from both a finance and legal perspective, that's really compelling to me. It's a different viewpoint than we hear a lot of times.
See, that's interesting, because one time you told me that my emails sounded too much like a lawyer and that you thought they turned you off.
Well, yeah, but you're not advising me on the legal aspects of something. You were like
inviting you to a fantasy football league.
Yeah.
Speaking of email, one of the things that I love that she said, and that I am incredibly jealous of, is she said her superpower is responsiveness. I just pulled up my inbox and it is a mess. I would love if my superpower was responsiveness.
Are you still using Hey?
I am still using Hey, and it's phenomenal because it helps me get through all of the things I don't need to respond to get put off to the side, and I can kind of browse at my own leisure. But I do have a very large, hey, get to this pile right now, and that needs to happen.
So Eric, we started this interview talking about you being Mr. Accredited Investor himself. How difficult does it feel to you sitting in a position where it's like, oh, I could probably start a syndicate right now, to get to the point that Ashley is right now? Like going from 0 to where she is, now that you technically have the ability to. Does that seem doable?
It seems doable. I don't know that without doing 100 deals on your own, it would be as quick. But I think that if you have this interest and you're willing to dive in and you're willing to spend time on it, yeah, I think it's doable. I think that the syndicate lead style and the benefits, she mentioned that if you want to start investing in syndicates or if you want to be a syndicate lead, the best place to start is with AngelList because it's a platform, so it's going to help you with discovery. It's going to help you with a lot of the things that are harder. So it's doable. I think it would be very hard. I wouldn't be able to do it part-time while I'm also general counsel at a real estate investment fund. That's for sure.
Yeah, super, super impressive what she's doing. Like Eric said, we'd love to hear from more alternative financiers. So if you know somebody in the space leading a syndicate or doing something different, like a rolling fund, we'd love to hear from you. You can tweet at us at UpsideFM or email us hello@upside.fm. And we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep